Hi, welcome to this episode of Talking Tax with Alex. This episode is going to be a little different. I'm going to talk about the Employee Retention Tax Credit, which is something that I'm actually dealing with professionally right at this moment. So it's going to be a very informative video, and it should be timely. And if you're an employer and you haven't filed for this, or maybe you did file and you want to see if you qualify for more, this video is for you. So in this video, I'm going to quickly talk about what we're going to cover. What the ERC is about, we'll just touch upon that briefly. Eligibility, this will take a little bit and we'll cover the different types of qualifications and eligibility. I'm going to talk about the warnings the IRS has given out in the last 6 months or so, and then I'm going to end with my closing thoughts, what I think you should do. So really quickly, this video is your quick guide to the ERC credit. It's going to cover the topics I guess very shallow, but we can go in more depth if if your situation requires it. So what is the ERC? It's a refundable payroll tax credit that's filed on Form 941X. That's your payroll tax form, Form 941X, or Form 941X is the amended. There's a maximum credit available of $26,000 per employee, as broken down here. So for 2020, you're only allowed $5,000 per employee for the entire year. And for 2021, there's up to 3 quarters where you can get $7,000 per employee per quarter. So that's $21,000. That's your $26,000 per employee. This is available for tax years 2020 and 2021. And the statute of limitation to file ends April 15th, 2024 for your 2020 filing, April 15th, 2025 for your 2021 filing. So I expect a lot of FOMO and year-end filing to try to rush and beat the deadline. So eligibility, this is important because this will determine how much your wages qualify. So if you're a small employer, there's two definitions of small employer. In 2020, if you have less than 100 full-time employees, and I put that in air quotes for a reason, or in 2021 you have less than 500 full-time employees, then you're a small employer. A full-time employee is not what is a full-time equivalent, which is used in the benefits like health insurance and benefits arena. Full-time employee is defined as an employee that's worked 30 hours per week or 130 hours per month. And if you're a small employer, all of the wages you paid the employees to work and to not work qualify. So it's in my practice and what I've seen, it's really important to be a small employer because everything that you paid, all your payroll is eligible. On the flip side, a large employer, as you can guess, is the opposite. So if you have more than 100, more than 500 full-time employees, and the reason why this distinction is really important is because if you're a large employer, only wages you paid employees not to work qualify. So there's a very important distinction there. What you paid employees not to work is, for example, if you own a lot of restaurants and you had to pay a certain amount of staff to just sit at home during COVID. That's what this means. So there's a couple ways to become an eligible employer. There's a couple tests. The first one, the most easy test to understand and qualify through is the gross receipts test, and you measure that quarter by quarter. So you look at 2019 versus 2020, quarter by quarter, and if you have a drop in gross receipts more than 50%, then you qualify for 2020. And then for 2021, you look at 2019 versus 2021 quarter by quarter, and if you have a drop in gross receipts more than 20%, then you qualify. So the 2 years have 2 different rules and 2 different thresholds. Q4 is not available, except if you're a recovery startup business. I'm not going to cover that here. It's other than saying that if you had started a business after, I think it was February 15th, 2020, then you could qualify and Q4 would be available for you. The second test, which is a lot more difficult to support, is the shutdown by government order test. And this test requires that you need to have a government order that shut down your business. And there's a bright line test, which I call the 10% by 10% test. And I know there's going to be 3 10% coming up, but just bear with me. 10% by 10% test, whereby if you experience a greater than 10% drop of gross receipts or a greater than 10% drop of employee hours in a greater than 10% portion of your business. So you need a one greater than 10% drop in a greater than 10% portion of your business. What does this mean? Well, this is a area that's very open to interpretation, facts, and circumstances. And you need to be under a qualifying government order. So in California, we had a stay-at-home order and modifications in place from March 2020 till June 2021. And so if you can show that you had a 10% drop in gross receipts or employee hours in a portion of your business, this portion can be a separate location, it can be a service line, it can be another segment of your business. So let's say you do online sales and you do retail sales, and your retail front of the business got shut down by government order or heavily modified, then you can qualify. So this test requires a good facts and circumstances support, and you want a professional, someone like me, or somebody that really understands this part of the law to create your supporting documentation. Furthermore, if you're the shutdown by government order, if you're an essential business, you can still qualify through the modifications test. So the modifications test is basically if 90% or more of your business can continue, but the operations are subject to modification due to a government order. For example, that retail store we just talked about, where you could stay open, but you had to close your retail front and you can only do curbside pickup, and you could show that 10%, you experienced a 10% drop in gross receipts or employee hours for that portion of your business, and if your retail front was 50% of your business and you dropped 10% of gross receipts on that, then you could qualify even as an essential business. Another part of this is if you have a non-essential portion of your business and you pass this 10% by 10% test. And for example, this would be like a hospital with non-emergency surgery. So if non-emergency surgery took up 20 or made up 20% of a hospital's business, and they had to shut it all down, so they lost 20%, that's more than 10% of their business. So they would actually qualify as having a government order shutdown. Finally, is a supply chain disruption. This one is the hardest to qualify. There's not really a 10% by 10% test, and you would need to show that there's a foreign or domestic government order. It impacted your supplier's capacity to deliver essential goods to your business. You could not find another supplier, and this disruption caused a demonstrable operational consequence to your due to your inability to acquire essential goods. So this is really facts and circumstances driven, and I would caution against anybody who just says, "Oh, you have a general supply chain disruption, you qualify." You really need to have all of your documentation and support to qualify for this, and I would probably use the 10% by 10% test just to be as a safe harbor, but there is no actual defined test on how to qualify for this. It's all facts and circumstances. So I'm going to quickly go over just IRS warnings about ERC potential fraud. And what I'm doing by this is just to show that IRS has been telling us tax professionals that they are going to audit this. There are a lot of unscrupulous preparers, a lot of people that are saying everyone qualifies no matter what because they are after the fees. And third parties are promoting these and basically filing improper claims and not having the support and meeting the eligibility requirements. So in October, they made a statement. The IRS made a statement. In November of last year, they made a statement. March again, and this year they made another statement. March 20th, again, they made another statement. They put it on the Dirty Dozens list. So the Dirty Dozens list is the IRS naughty list for tax, basically very open tax issues where these issues are more prone for fraud. And then again in April 2023, there's ERC schemes. So this is like 5 warnings the IRS has given us tax professionals in the last 5 or 6 months. My closing thoughts here are one thing to note: there's additional income tax and compliance required. You do need to file amended returns when you receive the money. for the years in which you qualified. So if you qualified 2020, 2021, you have to file amended returns for that. So be careful. And then beware of shaky eligibility claims. Any promoter that's coming and saying, oh, you qualify, and they can't tell you exactly what your eligibility is, or it just seems like they don't have a really good fact pattern, or that you don't have a good fact pattern, you should be really aware of that, because there's a high audit risk on these. You definitely need to consult a trusted advisor. And I do this for a living. So I've worked on many clients in establishing and supporting their facts and circumstances to file these claims. And I do consider myself a trusted advisor. If you do like this video and like this content, please like the video, subscribe to my channel, and comment me or email me your thoughts. Thank you. Bye-bye.